If you're planning on running the next revolutionary business, sooner or later you're going to need some funding. Perhaps you've looked into how companies get funded and you're confused by some of the financial ease. Well, worry no more. Today, we're going to be diving into two of the most commonly discussed types of funding and sorting out the differences between them so you can talk business with the top investors the world over. This is the who, what, when, and how of private equity and venture capital. What do they have in common? Both private equity and venture capital are forms of private investment, where the companies are not publicly traded on the stock market. Like all investments, they both involve the exchange of a substantial sum of money for partial or total ownership of a business. The company receives a much-needed influx of capital for the business, and the investor hopes to see a return from their investment. How are they different? Private equity and venture capital differ in the types, sizes, and ages of the businesses they invest in, as well as how much money they invest, how much equity they acquire, and how involved the investors get with the decisions of the company during the investment period. Let's start with private equity. Private equity is reserved for only the most established, most stable companies in the world. Investors buy into established companies that may be experiencing hardships or not returning profits to their full potential, with a goal to streamline their operations, rejuvenate the company, and increase revenue. They typically buy full ownership of a company in what's called a leveraged buyout, thereby giving them total control of the business. Their investment is concentrated into one company, as there is little chance of an absolute loss on an already established business. This buyout usually involves a substantial amount of money, with buyouts reaching tens, hundreds, or even billions of dollars. But it's not all about who can put up the most cash. Private equity is about management as well as funding. Any investment in a company involves the founders giving up a measure of control, and private equity takes that to the extreme. As these investors buy a majority stake in the company, they have the power to make major decisions for the business, including changing operations or even firing the entire executive team. Think of private equity investments like flipping houses. The firms buy businesses that need some work, fix them up as quickly as they can, and then sell out the newly redone business to cash out on their investment. Let's look at PetSmart. PetSmart has been a beloved brand for pet owners since the 1980s, but in 2014 they found their sales beginning to slow. With their loyal customer base and relatively strong cash flow, they were in the perfect position to benefit from a leveraged buyout. The investment firm Baring Capital Partners took an interest in the company, and with the backing of their limited partners, ended up buying PetSmart for $8.7 billion. With the buyout, the business then became privately traded and was delisted from the stock market so that work could begin. And boy, did it begin. Within a month, the leadership team had been restructured, with over half a dozen senior managers being replaced. This allowed the executive team to make decisions faster and more effectively. In addition to improving the efficiency of their operational processes, VC Partners also implemented zone pricing across the United States and adjusted the prices of individual items to maximize profit on hot-ticket items and encourage sales of underperforming products. Add to that the individual attention paid to each store's sales volumes, and PetSmart saw their oversupply and inventory problems disappear practically overnight. The investment and resources provided by VC Partners also enabled PetSmart to launch a research campaign in order to get to know their customers better. They explored pet owners' favorite things about shopping at PetSmart and used the answers they found to help them perfect the services they offered. More grooming services, more in-store veterinarians, and a doggy daycare. More of everything that brought pets in with their owners, so that the store became not just a shopping space, but a social one too. In the words of PetSmart CEO Michael J. Massey, this was a business with a strong sense of community, one built around smiles and kisses. All of this paid off in a big way for both PetSmart and VC Partners. Their sales, which had been below average and slowing prior to the buyout, shot through the roof. Profits went up, costs went down, and in less than a year, PetSmart was able to return to their investors a dividend of $800 million. PetSmart was back on top of their game. So what's venture capital? Venture capital investors put their money into newer, less established businesses with a view to make above-average returns on their investment once the company delivers on its potential. These investments are much smaller than private equity investments, usually $10 million or less, and are typically in companies in the tech, biotech, or clean tech industries. Think about Shark Tank or Dragon's Den. Entrepreneurs with great ideas who need funding to get off the ground and investors who want to help them make it big in return for big profits. Venture capital firms typically invest with less than 50% of the company's equity. This way, they can spread their resources across a number of different companies, giving them a greater chance of being on board when the next big thing strikes. This also means that they are less susceptible to failure. If your eggs are spread out in different baskets, you can't lose them all. Venture capital can also include an element of guidance. As the founders of the business are usually new entrepreneurs, they might not have a great deal of industry contacts or market experience. Venture capital investors can help, making introductions and giving advice to help the young business grow and thrive. Take Snapchat, for example. Born from the minds of Stanford students Evan Spiegel and Bobby Murphy, Snapchat was conceived as a pushback against the permanence of other social media. The photos that you frantically untag before a job interview, or the statuses you post on impulse and then delete, hoping nobody saved a copy. Snapchat, by contrast, was made up of fleeting moments. In 2012, their app was barely a year old and had not quite 100,000 users. They had a unique idea and a small but solid user base. What they were missing was the funding and industry clout to push them into the big leagues. Enter Jeremy Liu. A partner at Lightspeed Venture Partners, he had heard of Snapchat through a colleague's daughter and wanted to know more. After meeting with Spiegel and Murphy, he knew they had an idea worth backing and wrote them a check for $485,000. With that funding and the industry knowledge that Liu brought to the table, Snapchat took off. By the time the company went public in 2017, Snapchat had over 150 million users, sending a collective 2.5 billion snaps each day. And with a total company value of $25 billion, Jeremy Liu's $485,000 check had grown to a massive $2 billion in equity. In short, private equity is for large companies who are established but are struggling to hold the same power they had before. An investment company will often buy a controlling or complete share of the company at a hefty price and will sell their shares in the company once they've turned the business around. Venture capital is for smaller companies who are newly established and need an influx of cash to make that next big step. Investment in these companies is less about control and more about return, leveraging a small investment into a big payday when it comes time to go public. Investors often play a mentor role rather than an executive one and can provide valuable experience to the founders without needing to steer the business themselves. Now that you understand the ins and outs of private equity and venture capital, it's time to put your knowledge to good use. You can now confidently discuss investment with other entrepreneurs, identify and negotiate the right type of funding for your business, and one day, maybe even become an investor yourself. But until then, hit like, get subscribed, and watch more videos like these.